Well, hello again from Sprott Money News, sprottmoney.com. It's now September 2022. It's time for your monthly precious metals projections. We're going to talk a little more than just precious metals this month, as man, there is a lot going on. I'm your host, Craig Hemke. Joining us as usual, Chris Vermeulen of the technicaltraders.com. Good to see you, Chris.
Hey, thanks for having me, Craig.
Always fun, my friend. A reminder, the usual reminder, actually. This content obviously free of charge here on the internet, but that you really should thank the folks at Sprott Money for putting this together for you, having Chris and I come on and do this for you. You can do that two ways. You can go to the Sprott Money website, as you see right here that Chris has pulled up. Always great deals at Sprott Money, great storage deals as well. If you want to have a nice, safe, secure place to hold your precious metal. But also, if anything, if you're not in the market for precious metals right now, at least give whatever channel you're listening to this on, whether it's YouTube, Spotify, whatever, give it a like, a thumbs up, hit the subscribe button so you're notified every time Sprott Money puts out new content. That, if you don't know this stuff, that actually helps Sprott Money get a wider distribution, get more information out there into more ears, and that helps the cause for all of us. So please, at least, if anything, give us a like or a subscribe on whatever channel you're listening. Chris, we sit here, we start September. There's all kinds of stuff going on. And we'll try to touch on some of it over the next few minutes. The energy crisis in Europe is probably going to be a huge driver over the next 6 months through the winter. And that'll be a concern, obviously, for everybody. But as the month begins here, you're really beginning to feel that across the global markets. All of this central bank tightening, especially by the Fed, is driving the bond market lower, the stock market lower, the dollar higher, and all of these things are having a rather adverse impact on the precious metals. We've been in periods like this before, though, and as part of your service, I know that you've navigated people through this type of climate. For those people listening, just kind of give them some idea of what they can do, what they should be watching in the weeks ahead to kind of help them, preserve capital and stay nimble.
Yeah. So, I mean, investing if you're going to be an active investor, a tactical investor trying to dance around and not just kind of buy and hold, what I've found is kind of the most easy way to try to navigate the markets and avoid big sell-offs. Like you look at this chart here, this is the daily chart of bonds over the past about year. And I mean, it's just been an absolute bloodbath for anyone who's got, any type of bond holdings in their portfolio. And I've come up with a solution. I mean, I've been working on this for over 25 years, always trying to find out how do I find the best asset now, which you and I have talked about many times before. And my philosophy is I don't believe in holding any position if it's going down. You're not going to see me buy and hold. I'm not going to hold, stock and bond split portfolio, because if something's going down, it defeats the whole point of what we're trying to do as investors, is grow our money. So I take a very different approach, and this is going to lead into where we are in the markets today and where I think the best asset, the best position at the moment is. So I like to look at the market from this kind of position hierarchy, I call it. So we've got the SP 500, which to me, the US stock market is the best opportunity. If the stock market is favorable, we want to be in stocks and really all in stocks. I only usually take one position at a time because there's usually one sector that is on the hierarchy that is better than the others. So if stocks aren't in favor, then I look to bonds. If bonds are not in favor, which they haven't been since, almost halfway down the COVID crash, then we look at the US dollar. And if the US dollar is not bullish, then we look at UDN, which is the inverse dollar. And then, of course, then on top of that, we've got the bill, which is the short-term T-note. So you can just move to cash and earn a little bit of interest while you're sitting in cash. And what's interesting here is these last three positions are more or less a cash position, but we can make money sitting in cash. And as we know, this year, one of the best assets has been the US dollar. We'll look at this chart shortly, and it's been performing very well. And, I like to look at things that when volatility picks up, we want to step back from the markets. I do the opposite of most other people. When volatility picks up and things start moving, people seem to get excited. They jump into things. They try picking tops and bottoms, and usually it ends very negatively in the long run for them. And so this column right here, this 20-day Donchian percent volatility, this is telling us over the past 20 days what the extreme high and the extreme low percentage swings are. So for the SP 500, it has swung 14% within a 20-day window. Bonds are just over half of that. The US dollar is about half of bonds, and then sitting in cash more or less is very low volatility. And so that gives you an idea of when things get chaotic, we start moving down the hierarchy to slower moving, more conservative assets. And it doesn't matter if the dollar is rising or falling, one of these ETFs could and should be moving up in favor so that we can actually profit in a cash position. And I also like to look at what the daily range, just the intraday high and low over the past 20 days has been. You can see the SP 500, 2.5%, the bonds 1.75, the dollar only 0.75%. So this is how I like to look at the markets. And I always follow this hierarchy that if stocks are not in favor, then I go to bonds. If they're not in favor, we go to the dollar. So this type of scenario keeps investing really low volatility, keeps the trades slow and consistent, and the returns. So here is the COVID crash. So generally, if the top SPY, you can see these different symbols, TLT, UUP. This is our hierarchy chart. Naturally, we're going to be long stocks when they're favorable. But when our system gives a sell signal telling us that big money is flowing out, the trend has changed, we move down the hierarchy to what the next asset is. And in this case for COVID, it happened to be bonds. They ended up running up. It hit our targets and hit a trailing stop on this following day. And we actually got out of bonds. And then we moved into a cash position after that because neither the UUP or UDN actually gave us a signal. They won't always give us a signal to be in. And then we sit in cash, earn a little bit of interest with T-bill until we get a new buy signal in the stock market, which we were able to get back into the stock market at almost a 13% discount and then ride up that next big rally. So this shows you how you can just dance around this market. As the market gets volatility picks up, we're stepping back and moving away, but we're still generating growth in our account. This year, very similar scenario. We were long stocks. We got a sell signal. Bonds were not in favor. We got into the UUP. It had a nice move up. We got a new buy signal in the stock market. We played that for a small move. And then we got a sell signal. We moved back into the dollar. The dollar's been rallying. And that's how this year has more or less played out with this strategy. So it's a very interesting way to try to navigate the stock market, considering this was one of the worst starts to a year for equities and continues to kind of almost get worse here by the week. This makes it pretty painless and low volatility as we go into that stuff. So, I mean, when we look at the bond chart here, bonds are clearly out of favor. And as you were saying, where is that best asset right now? And to me, the dollar is a very good signal of what's going on in the world, where the money is flowing. And this is where we have been. In fact, this morning at the opening bell, we actually closed out a portion of our UUP trade. We closed out 3/4 of it for a nice gain. And we closed out a nice trade on the indexes from about, you can see here, we played a nice bounce in the US, the SPY. We took some partial profits. We got the rest out. We got in UUP while the stock market's been falling. So we're making money in the bounces. We're making money as the market pulls back. And we're doing it in a way that is very low volatility. And the dollar, you can see here, when we had a sell signal, we get into the dollar has just rallied. And to me, the dollar is really gives me a pulse on the fear of the market. If the stocks are selling, the dollar is rallying, especially if bonds are selling off, we've got real panic in the market. And it puts major headwinds on almost every other asset, including precious metals, which is why they've been under so much pressure, right? And so right now, the best asset to me is actually the dollar. And I think it actually has quite a bit more potential to go higher. And, you know, things could get pretty gnarly, as you and I were talking about before we started recording here. So for precious metals.
Well, let's break those down a little bit with those three components. And let's do that this month, because again, you make a great point about reducing your exposure when asset classes are going down, and really all asset classes have been going down. You know, if the Fed and the other central banks are going to blow the everything bubble. Then when the everything bubble pops, everything goes down.
Yep.
And this year, the typical, kind of financial planning advice is, oh, you've got 60% in stocks and 40% in bonds as a, a diversification. Well, this year, the whole 100% has been going down. And this has obviously been impacting the precious metals too.
Yeah.
Let's start with, I see you got the chart of the dollar there. The dollar, is the computers that trade the precious metals futures. If the dollar's going up, they'll see that intraday and maybe sell some precious metals futures. And if the dollar goes down, vice versa. This has been an issue for quite some time. The dollar's up dramatically, more than 20% in the last year. It looks a lot like 2014, the last time that happened.
Yeah.
Chris, what do you see there? I mean, again, understanding there are component parts to the dollar index. It's not just the dollar.
Yeah.
That index is weighing the dollar versus other fiat that are just devaluing faster, like the euro and the yen. But what do you see in the chart that might suggest a top or maybe another extension higher?
Yeah. I mean, I think, I'm not a perma bear, and I try not to shoot fear across everybody, but I think people need to be really, the market always does what we least expect. And I have a feeling we could continue to see a lot of selling in stocks, panic continue to climb, selling in bonds, which to me, actually the sell-off in bonds is going to create more panic than the stock market, because the majority of investment capital is with people, nearing retirement, retirees, and they're heavily weighted. Pretty much, one of the theories is you put your age in bonds. The older you are, the more bonds you have. And unfortunately, most people are not, or, investors and advisors aren't really tactical investors. They're kind of, you buy your split of stock and bond, you ride it out. But we could continue to see bonds fall, and it's going to create a lot of panic, a lot of selling. And I think the dollar could still very much so benefit. I mean, and rally, and that's going to create the surge in the dollar index. We're going to see liquidation across all asset classes, and the rising dollar and real panic among investors around the world. It's going to send a shockwave and a massive bout of selling that's going to create margin calls and liquidation, and see a huge slide potentially in commodities and in stocks that people are not expecting, and bonds too. I mean, I think we actually have a big potential here in bonds. If we look at the chart of bonds and go way back in time, we've been in this massive, let me go way back here. This is far back as my data goes, but more or less we were, in this, we broke into a bull market. We've been in it forever. Now we're in this major topping phase where bonds, I think, are now going to start heading lower. And I was doing some calculations on, I think, Thursday with our mentoring session, our investors, that bonds actually have the potential to drop another 20 to 30% where they are right now. Like, we're talking, this would send the shockwave through the investment world like no one ever expected. And it's weird because the market always does something. You go from one extreme to the other, yin yang. Right now, you can't find labor. Everybody's making a ton of money doing, pretty basic standard jobs because there is no labor available. If bonds were to collapse another 20 or 30%, and the stock market collapses another 20 or 30%, all the retirees, which is like a very large portion of the population, are going to have to go back to work. And we're going to go from no labor to everybody wanting a job. And I think we could potentially have such the biggest swing in economies, from the strongest to the worst very quickly. And it sounds really bad, and it is really bad. And I'm not saying it's going to happen, but we are really close to something like this happening. And it can actually happen pretty darn quick. This is a monthly chart. 6-8 months from now, bonds could be down another 10 or 15 or 20%. So could the stock market. And we're going to be in that situation. And, people who can't manage or don't know how to manage, positions or investments, like just buying and holding, are riding one heck of a roller coaster ride, and risking everything. I'm all about a cash position. I would much rather watch price action or miss out on upside than potentially risk, changing my lifestyle and losing money and worrying about, outliving your money and all those things that come with a falling stock market, right? So there's some pretty big picture scenarios that don't look too bright, and we're kind of on a teetering point that it could happen.
Yeah. Well, and just from a day-to-day buyer and seller standpoint, remember, lower bond prices mean higher yields, right?
Mhm.
And so a lot of us think, well, rates can't go that much higher. But then you think about it, well, who's buying treasuries? If the Chinese aren't buying treasuries and the Russians aren't buying treasuries and the
Yeah.
ECB is not buying treasuries and the Bank of Japan's not buying treasuries, and now the Fed isn't even buying treasuries for now, who's left? Nobody buying, and you get
Yep.
more sellers and buyers, and down goes price. I'm sure the Fed will probably be the buyer of last resort, just like the Bank of England or the Bank of Japan. But in the meantime,
Who
goodness
knows?
gracious.
People, I know people are saying, certain rate levels, but for all we know, we could see another huge rate spike. Like,
Good.
I mean, it could be absolutely ballistic. And of course, I talked about this a long time ago that I think the market is going to have some crazy wild swing, and real estate is going to go from the hottest commodity. Now it's already topped, and I think it's started a very long journey sideways and lower. But mortgage rates, 30-year mortgage rates have jumped dramatically. It's already getting hard to get mortgages.
Right.
People can't afford the homes at the prices now because the mortgages have like doubled. The rates have like doubled in the last few months. So a house that was, $1.5 million in your budget, now you're like, well, now I can only really actually get, $750,000, $800,000 house just because of the mortgage. So now there's going to be all this pressure. So yeah, we're in for a very interesting time. And
Right. Well, let's carry that over to the stock market, because this is probably the thing that would ultimately drive a Powell pivot and get the Fed back into the QE game faster than anything else. I'm watching myself the 3,900 level on the S&P, but then those lows earlier this year around 3,600. You can see that on that chart.
yeah, I'm just going to pull up the weekly here.
What will you be watching? Because again, the interesting thing about technicals is the increase in validity, the more people that are watching, right? It kind of becomes kind of a self-fulfilling thing. Everybody's watching the same level, and when that level breaks one way or the other, everybody moves at the same time.
Yeah.
How far could the S&P fall if by chance it takes out those earlier lows?
Yeah, I mean, if we take a look at this, we can use Fibonacci. So a couple of ways we can look at this. Overall, I think we've had like an A, B, C correction. So a nice, usually you have a bear flag in a halfway move, more or less. If we use Fibonacci, which I find works exceptionally well, we can look at the this full rally. So this would be a 3-wave down, and then we're coming up. And if this is the high, this is going to give us an idea of where that next downside move is. So from where we are right today, we come back down to a double bottom, more or less. That'll be the 618. And we'll probably have some bounce or short-term pause there. That's about 7-8% down. If we do have a bounce and a pause off the 618, we almost always hit the 100% measured move after that, I've found, in the SP 500, which means we could see an 18-19% drop from where we are right now. And bonds are probably going to drop very similar.
Right.
I mean, geez, they were going like neck and neck. They were fighting to see who could drop the most earlier this year. So, I mean, this is the weekly chart. So we're looking potentially 2-3 months out. Could be a very different story from where people are sitting, thinking, and feeling right now. And people's financial outlook will change dramatically if that happens.
Right. And again, how all these things connect. Yeah, maybe eventually get a safe haven bid in bonds if the stock market's collapsing. But if the stock market's going down and the bond market's going down, that's just going to make the dollar go up even further.
Mm-hmm.
And you put all that together with the general liquidations and margin calls and everything else that goes on, as valuable as gold and silver are. And we always, look for opportunities to add more physical.
Yeah.
The way that these things are traded through the derivative and the futures contracts, you can get all sorts of liquidations. And so I think we should close this month, not, to be bearish and scare people and all that kind of stuff, but as much as we get excited about the long-term potential for the precious metals and owning them as a security and insurance policy against, where this monetary system is headed. In the short term, there's always the potential to route the futures contracts. And what I've been warning people on my side and what I'm watching most closely is that period in the left-hand side of your chart there. That's something that anybody that's been in the metals for a decade will recall. Price spiked in 2011 all the way up to 1920 and then sharply pulled back and bounced on multiple occasions from that 1525 to 1550 level. It would go down there and bounce, would look pretty good, but then it would go up to 1800 and stop.
Yeah.
And we were like, wow, boy, what's going to happen here? Well, we know what happened. We got into April of 2013. Price fell below 1550, went down $60 on a Friday, falling below that 1550 level, and then went down $140 the following Monday as stops were run. And you can see that plunge.
Yeah.
Right. So now, Chris, let's look at present day.
Yeah, it's a scary picture. If this doesn't hold, it's going to be lights out for a little while.
Again, same thing, coming down, bouncing off about 1680 to 1700 on multiple occasions, going up to near 2000 on multiple occasions. And again, what happens? It's like we talk about the technical analysis. Everybody look at the same chart. If everybody looks at that like they did in 2011 and through 13 and goes, well, if it ever breaks down below 1525, I better put my stops in there. Mm-hmm. Then all of a sudden you get everybody and their brothers got stops in there. And that's what, the result, we know what happened. And I would imagine there's a few stops, around 1660 and 1650. So with that as a backdrop, that's a long question. Obviously, you see the same thing.
Yeah.
From a technical perspective, if there are stops that get run, if the dollar spikes, if the stock market collapses, you get all this liquidation going on, and we drop below 1680, where do you see support? Where would be a spot that somebody would go, okay, here's where I might be looking to step in and buy some physical?
Yeah, I mean, a really basic way just to get an idea of the overall momentum. I usually like to use at least two highs and two lows. So if we were to just kind of box in that pricing, I usually look at this type of volatility built in, like the amount of volatility built in this sideways channel, I find can be, extended to the downside, very much like a head and shoulders pattern. You can take the neckline up to the top of the head. That'll give you the momentum of the breakdown. This is the same type of thing, but with a double top. And that brings us down to 13, which is, right through all of this noise through here. I mean, really brings us right back to the first leg where we broke out in 2019 to the new bull market.
Can you not do about the exact same thing to that top back in 11 and 13? Put your same box on there. Okay. Extend it down. Yes,
it brings you down. There's the odd little shake down there, but I mean, it's the same type of thing. The first momentum move is so strong, right? Like it came right down, got darn close to that level so quick. And I think if it was to break down, we're going to see a very similar type of setup. I mean, just looking at this chart, when you look, back in time, I mean, it's pretty clear. They look very, very similar. Other than this one long wick candle, I mean, it still came up and broke some of these little highs and then came down. This one did the same. It actually came up and broke this previous high. And now here we got this, it came down, it bounced. Well, we've come down, we've bounced. I mean, this is a possibility, right? And this is what most people don't. People want to look beyond the negative. Like I know the amount of emails I get right now of, can I buy gold now? Can I buy gold miners? Like everybody's trying to pick the bottom. And I think it's a good opportunity if you're a bottom picker. And we're at a support level, but if support breaks, it's going to break quick. You're going to get probably a fairly bad fill because it's just going to drop like a knife straight down in seconds or minutes on the chart. But you got to get out. If it breaks, like as you said, I mean, we could see a very sharp drop, and gold could be out of favor for a while, which is what you and I have talked about. I feel like gold's not going to be in favor until sometime later next year. I think the stock market's going to continue to sell off. I think the sell-off in the stock market's going to pull precious metals down. Usually precious metals get pulled down with panic selling and investors dumping positions. It's natural. So I think gold is going to be under pressure because of that. We have the dollar surging, and I think the dollar has a lot higher to go. I think it can go to 116, 120 very easily, which will add more fuel to this sell-off in precious metals. Right. But I have a feeling we're going to see the dollar top out, somewhere around the 120. Stock market's going to bottom out another, 15 to 30% lower. And who knows where gold is. But when those things come about, I think that's when gold puts in the next major bottom. And we see that huge rally. So I'm very bullish on precious metals, but I mean, I'm still not really super excited for another 6, 8, 12 months probably.
And And I just would add kind of a fundamental caveat to this chart, which is, remarkably similar to 11 through 13, but this isn't 2013, right?
Mhm.
That's the thing people need to keep in mind. It's not 2013 economically or geopolitically, monetarily, nothing.
Yeah.
Now there are similarities, obviously, and if those stops get run, you're going to see it. But that 5-year period that followed, that big rounding bottom between 14 and 18,
Yeah.
was a period where the Fed played the same rhetorical games that they're playing now.
Mhm.
We're going to run off the balance sheet and normalize interest rates and all that crap. That worked. They were able to pull the wool over his eyes for 5 years, and then the result, when they finally admitted that they couldn't do that beginning in late 18, was that next rally.
Yeah.
I'm not sure they can do it for 5 years again this time.
Yeah. I'm not sure either.
But regardless, I just wanted to make sure we covered that today, because though we may continue to hold 1680, and who knows geopolitically what's coming over the horizon in the next 6 months, people just need to be aware, so that if this does develop, if you do get a drop like we got in 13, that you kind of keep your wits about yourself,
Yeah.
and understand that, hey, if they're going to run the paper price that far, it might be a good chance to get some physical metal. And so
For sure.
just want to make people aware that that is at least a risk. Anything else on your mind, Chris, before we wrap up?
I think that's about it. I think we kind of covered it all. And yeah, I think the biggest thing here is people who are holding on to positions. I know a lot of people who've been writing into me have been buying miners, and they keep going lower. And GDX is, making like multi-year lows, and they're like, I just added more. I mean, people who are trading that way, it goes against every bone in my body. I don't buy assets falling. I don't pick a bottom. I don't do that. I wait for a reversal and get on a trend moving higher.
Yeah.
Just this type of drop that we just talked about in gold, if this is to happen, it's going to devastate somebody's account who refuses to just get out of miners,
Right.
get out of a trade going south. I know a lot of people who have been buying bonds recently, and I'm like, bonds they're not in an uptrend. You don't really want bonds, and they keep accumulating. And I know some of them finally liquidated their positions, and bonds have fallen a lot away from there in the last couple of weeks. And they're like, oh, thank God I sold those. So people just need to sometimes bite the bullet or be ready. If gold breaks down, I would, be ejecting out of any gold miners if you hold any. I own 0 gold miners because I think we're still far from the new real bull market there. Just know that there could be devastating 50, 80%, sell-offs in gold miners very easily if this was to take place.
Yeah. What would the free cash flow and the earnings look like at $1,400 gold?
Yeah.
This is just fundamental things. It doesn't change the long-term picture. It doesn't mean that the monetary policy and all the other reasons why we own physical metal, it doesn't mean those have dissolved. It's just that the markets may be poised to do this kind of stuff in the weeks and months to come, and you just need to be aware.
Yeah. And
Chris,
and physical, I look at physical metal a lot different than gold miners. Miners are there to make money. They're a trade. They're an aggressive move. Physical metals, I mean, they move all the time. We're looking at gold pulling back, 25% potentially. For a long-term asset, I mean, it's not the end of the world. The scenario is still there. I mean, I buy gold for long-term kind of investment, kind of hedge against some catastrophe, which I think eventually is going to happen, and we're going to see gold and silver come back in value. But so I like the physicals. And if it was to crash like this, obviously I see that as an opportunity more than anything else. So that's important. There's a big difference between physical and trading the stocks.
Yep. So keep some dry powder. It's always a good idea to add physical metal, but if you get a chance to buy it at a 20% discount from here, that makes it an even better idea.
Yeah.
Of course, when that time comes, you want to keep Sprott Money in mind. Chris knew where I was going. He had that webpage ready to roll. Again, you can see right across the top there. You can gold, silver, there's storage. And again, it's just something that is always going to be your insurance policy against how this all plays out in the end. We don't know when it all plays out the way we expect it to. So in the meantime, we'll just keep track of price. We'll keep doing videos like this to try to help out, and we'll keep asking to keep Sprott Money in mind anytime you're in the market. Again, that's the website, sprottmoney.com. And the phone number, is it buried on there as well? 888-861-0775 to talk to an actual human being. Chris, I look forward to talking to you again, my friend, the actual human being. In about 4 or 5 weeks, we'll be past the next Fed meeting. We'll be well into October, and gosh, October is always a fun month.
Yeah.
In the meantime, thanks so much for your time. This has been tremendous, and I think very helpful for everybody that's watched.
All right. Well, thank you. Take care, everybody.
All the best, my friend. And thank you, everyone, for watching. And we'll have another precious metals projection video for you next month.